Greetings, Jonathan Camarda, as we move through mid-June into the end of the quarter already. So let's get started with what we've seen. And I'm going to pull up some screens for you here to share what I'm actually looking at. All right. So as we get everything up, we'll start off with the actual Fed projections. As you can see here, next week, Fed likely to hold rates steady, under the guise of, again, U.S. debt situations that we all hear about on the news. I'm not sure how new that is, but that's certainly percolating there. But really, more significantly, no signs of stress in the labor market. And what we've talked about generally, right? The labor market is usually the last shoe that drops, especially in a recessionary situation, which we're certainly not getting signals of an imminent recession, but certainly there are signs of a slowdown. We start to look at the job numbers. Again, they came in, not too strong, but not too weak. So just right, so to speak. Is the market like the numbers, as you recall, last week, and certainly puts the Fed in real no rush with them holding strong enough. So almost Goldilocks in that sense. Now we start to get to things like inflation. The Fed's number was 2%. But when you look at, I'm a big fan of Trueflation, which is really updates a lot of the metrics in a post-COVID supply chain world. You can see that we're just below 2%. You can see really the drop here from even late last year after we spiked back down to last fall's levels. Now you'll notice last fall is when the Fed initially dropped rates, and the Trueflation number was again down here in the upper ones. Here we are again, but again, consensus is that they will wait till September. We shall see what they do next week. But again, pretty interesting on that with a lot of the unknowns that they're talking about. And not moving. So as we get to markets, right, again, picking up where we left off last time. So on the year-to-date basis, our industrials, communications, utilities, financials have outperformed. However, more recently, when we start to really look at the outperformer, it's been easily tech, right? When you start to look at the fluorescent green line here, industrial still pretty strong, but you can see again the last 3 months discretionaries, again more risk on type sector motion there, along with communications. The underperformers the last 3 months, energy. Although we're going to talk about oil may have found a little bit of a bottom here. What that means, healthcare, of course, has been holding up the bottom as well. So again, you'll notice in a lot of your models that, again, equity and exchange traded fund selection based upon the strongest sectors, what we are seeing. So again, no surprise here, best performing asset classes, right? Large cap growth. And again, momentum with low volatility fading from its earlier outperformance during the April downturn there. So you can see value again underperforming, mid cap and small cap certainly not as strong as your large caps, which makes sense as well when we start to look at the dollar, which has been, as we talked about last time, staying pretty weak, from that standpoint. So I think what this cues up for me to look at, and these are just metrics I'm taking you through as I go through and actually matriculate through my my sources that I'm looking at and how I kind of put the mosaic of what we're seeing in the economy. So taking us to interest rates. So very interestingly enough about interest rates, try saying that 100 times. You can see shorter term interest rates currently pretty decently lower, and with the weaker dollar makes sense versus last year. Last year is the black line, blue line this year. But you can see on the longer term rates they are higher. And such, one could say, okay, as the Fed looks to what they're going to do, one can make the argument that they may have reason to pause, all opinions aside, in that you are getting a mixed picture there, with longer term rates higher this year than they were last year, and shorter term rates lower, from that standpoint as well. So we kind of look again to see where that actually takes us. And we shall see again with what the Fed does next week, with again the strong positioning there by most that they will remain in that, remain in the low 4 range, right? That 4.25%, 4.5% range at this point. So we start to again get down to where we're seeing Globally, again, we're talking about CPI, again, back to inflation, pretty steady here for the US year on year but in the mid twos, 2.4%. Again, still talking about, other than, some other countries like a Japan, our debt to GDP pretty high. But if you start to look at, again, GDP quarter to quarter, as you know, we had that negative number we talked about year on year, though, still pretty resilient compared to most countries, and certainly a lot of our European countries as well, where we're stronger. But then again, and if you look at essentially, the jobless rate, again, staying pretty steady, and that was indicated as well on the last report, where again, unemployment rate was unchanged at 4.2. So again, a mixed picture economically, right? So you can, make the argument that okay, maybe a steady hand. Now there are certainly again factors on either side that could tilt, but overall, looking at the Fed probably holding steady at this juncture, with that mixed bag of signals. As again, we start to look at what's outperforming, especially in the fixed income area, we start to see again where again our shorter term treasuries make sense, right? With rates lower, right? So the way we look at something like that and make those calibrations again with shorter term rates, right, lower than they were a year ago, right? You'd have outperformance because when rates go down, right, your bonds, your fixed income goes up. So you can see the shorter term treasuries outperforming longer term treasuries, which you can see are well in the red. Makes sense again, as I try to educate as well. So when you're looking at this as well at home, right, you see longer term rates higher than they were last year. Well, those longer term fixed income vehicles like your treasuries are going down and have certainly underperformed. Of course, with the risk on over the last couple of months, quarter to date, you're seeing again high yield bonds doing pretty well as well. And as you go back the last 3 months, you can see again that's stayed the same here with shorter term treasuries outperform longer term and fixed income overall, as we've seen again what the yield curve chart has done. So again, as you'll notice in a lot of these strategies as well, we've taken kind of a mixed picture there with the dollar going down, of course, short-term rates going down, but certainly what we've seen is your longer-term bonds. You can see obviously have gone down as well, 20-year Treasury. So in some of your strategies, you'll see where we take advantage by being longer, on longer-term rates going into those type of vehicles to take advantage of that. We start to look again, very simple metrics I showed you last time. Stocks to bonds, right? Are we risk on? Yeah. Well, you can see since mid-April, right? Stocks outperforming bonds, SPY versus the BND. We start to look at BND versus GLD. Of course, that's gold, right? Gold has easily outperformed bonds, right? So if you start to look though, and here's the real battle, right? Gold versus stocks. Gold again outperforming into April, right? And then of course in the rebound, stocks have had the upper hand, but gold still in a longer term upper trend. So we still like gold as well. Now we start to look at the price of oil again. As we know, we've been sinking here, right? When we start to look at energy as an underperforming asset classes, as you can see, I'm trying to interweave you the 3D zero graph charts as I start to look at all these metrics and we make decisions, which is what it comes down to. You can see energy has been an underperformer really over a period of time, versus other indices here, right? Over a rolling several months to show you. So again, you can see with the chart again of oil going down and then commensurately with energy. Now we may have found a bottom there, so we'll see again if we have some resiliency. Usually this time of year you'll see some resiliency with travel. Hasn't been as buoyant, but we shall see again if we do find some some upward trend, and perhaps what that means for the inflation metrics hard to tell at this point, as again it's been down. That has also helped keep inflation in line as well with lower energy prices. Now we start again to finish the picture. We just talked about the weakening dollar. We talked about this last time as well. You can see again the euro, the pound, the yen, the Canadian, the CAD, right? The Australian dollar, New Zealand dollar, I could go on and on. They're all outperforming the dollar pretty strongly. And you get a pretty good sense. Like I said, I just took you back to a chart, but I'll show you again. And all you have to do is, again, is if you look, this is the way I look at things, right? So we start to look at euro dollar, right? For those of you that trade currencies or look at currencies, right? So again, this is exactly what I showed you, just on a different chart. And that gives you an idea. And as you go across the metric on that, right, you can see where that essentially, plays out, right? The yen versus the dollar stronger. What does that mean besides just currencies, Jonathan? Well, of course, that would lend to also large cap stocks doing well, right? So I tied it all together. And so when we start to go through the factor analysis, like we were talking about, you see large cap growth doing well. Well, a lot easier for these companies that are multinationals to sell their goods overseas with a weaker dollar, even with the overhang, again, and the moving picture, if you will, of the tariff mosaic, which we still don't know the full resolution. This is still holding true. And that allows us, of course, to make asset class decisions, tying that all together, if that makes sense. Hopefully it does for you. So when we start to look, as well as when we start to look at heat maps, start to look at the most attractive stocks. Of course, one day is really just speculation, but over the last few months, we get a trend, right? You see the technology stocks, right, starting to come back. And over a 6-month period of time, of course, it was more of a mixed picture with some real weak names, certainly continue to be somewhat weak, and some of the other names, again, that are coming on strong recently, the names without getting into them. Now, a lot of the metrics that we'll use as well, beyond just how they're doing, is just, again, watching price to earnings ratios of these stocks across, again, price to earnings growth, not to get too deep fundamentally, just to see, again, the trends of a lot of these stocks on a fundamental basis. And then also when we start to look at global, right, like we did last time, you can see where the actual right, we start to look at, let's say, 3-month period of time here. So last 3 months, you can see pretty attractive across the board globally, as even Europe continues to do well. Asia's picked up as well, especially over a period of time here. You can see where there's definitely been some performance that we've looked to capture as well. And some of these specialties, technology and semiconductor plays there. So again, globally, you can see, again, pretty strong across the board there as well. And then when we start to look at sectors, again, and we start to look over a more recent period of time here, and we look again, again, you've seen real strength in most of the major sectors here, your technologies, et cetera, and your consumer discretionaries and consumer communications as well. Again, with some underperformance, certainly in, in short positions, healthcare, energy, et cetera, which have been more on the weak side. All right, so that's kind of a deep dive into where we see, as far as asset allocation. Now, when we get to overalls, we round third base here. In your allocations, you'll notice a lot of you really, over the last couple of months, have been very, very heavy in risk assets, really going back to late April for some of your strategies, some into May, unless you're a more conservative, which you were never that heavily allocated to begin with. Talk to your personal wealth advisor again, as far as your allocation and how that is applied. Again, well above these ranges here, which is the National Association, it, right? Active investment managers. These are tactical managers, not most advisors that you're dealing with. This is really the professional type institutional money. And again, we do kind of adapt some of our strategies to be very close to this. And a lot of clients are well overweight, even this, in risk assets, and have taken advantage over the last couple of months in that area. So getting back and tying it all together here with where we see the market before letting you go, and hopefully enjoying that summertime, right? Graduations, recitals, trips, family, flip-flops, the pool, and certainly staying eternally vigilant is what we're going to do, and hopefully you are staying frosty in that summer heat. So again, you can see the market again climbing almost really here on the S&P 500 to where it was, going back to the pre-tariff situation there, and then again, the way we look at it, Dow Jones still decently lower. So one thing that we're watching, for example, in this case, is watching again as that 20-day, that moving average crosses above the 200-day moving average, which is above the 50. So it's a very weird combination that has had bullish momentum, although we are seeing a slowdown. Now, typically this time of year, you will see a slowdown on the back half of June as things recalibrate. So in a situation like that, the beginning of July into the end of the July, a lot of times you'll see momentum, especially technology starts to roar back, and there may be some profit taking on the back end of June. So we may see some back and fill here as the market is really starting to challenge those highs from, again, pre-April downtrend. And again, same thing, the 20-day moving average roaring above the 200-day, which is bullish. But again, we are seeing a slowdown in some of the momentum there, as you'd imagine. Imagine a runner, right? You're running full speed, eventually slow down. We may see some backing and filling. What we want to do is make sure we can stay above, the green line here. And then as we drop down, where do we find support if that's the case? As typically when the market challenges highs from prior, doesn't always go surging through. A lot of times it won't. It'll kind of backfill and then kind of rest, and then hopefully find support there before moving higher. Again, stay frosty. We will see you next time. And hopefully this helps you give an idea of what we see and how we're actually making position moves on your behalf. And it is a privilege to serve. And Jonathan Camarda, until next time.